Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lummis. Today's conversation is with Jimmy Watson of Clavis Capital Partners. Max, what was a takeaway you had from our conversation with Jimmy?
If I had to pick my favorite part of the episode, I would definitely go with the exchange between Jimmy and Nicholas. Nicholas asks Jimmy effectively, when's the right time to sell? When is it better to have a bird in the hand versus two in the bush? And there was a nice exchange there, but Jimmy actually flips it back to you, Nicholas, and I thought you had some really great insights on that. And the three main points that you brought up were whether or not you've already accomplished what you promised to your limited partner investors, which is, of course, super important. That's how you sold the deal. And if you are delivering what you promised, then what more is there? And there could be more, but maybe not. Then you mentioned, is the offer good or is it extraordinary? I think if the offer is extraordinary and it's very obvious, then the whole situation's pretty obvious on what to do. The third point that you brought up, I thought, was the human element, which was super interesting, which was basically how tired is everybody? And I think some of these deals are really a grind for management and for the sponsor. And, who knows what happened during the hold period, if you went through COVID or if you went through some black swan event or some tragedy at the business. I think it's a great point that just being exhausted is not good for any team that's trying to drive growth at a business. And if you've gotten to a good return and there's an exit opportunity and everyone's tired, to me, it's extremely clear that it's probably time to get out. But a great point that you brought up, and one that deserves consideration, I think, from all business owners. But I'd also add a couple more or three more items to this if we're having this discussion. And I think one of them is, would you buy the company at the current offer that's being extended by others? If you wouldn't buy the company, that's a good reason to sell. If you would buy it all day long, well, maybe there's more meat on the bone. And then I think another point would be multiple expansion versus operational improvement. How much of the value creation came from operational improvement? If 80% did, maybe there's more work that can be done. Maybe you have an ability still to grow revenue and do more. If 80% of the value is coming from multiple expansion, that could indicate a frothy market. And who knows how long that market would stay frothy. And so it could be a good time to sell. The third point would be, I guess, what's called regret minimization. So if you did sell the company, what would be your regret? And maybe it's just that you left a little bit of money on the table. If the regret is that you have the potential for the whole opportunity to effectively blow up, I think that you should probably think about selling. And this gets back into the frothy market situation. If you look at SaaS valuations in late 2021, they were trading at, over 20 times revenue in some cases. Those same companies today, and this is in the public markets, but those same companies today are trading at 3 to 5 times revenue in some cases. So again, it's a lot of different factors, and I don't think anybody will ever know exactly the right time to sell. But there's a lot of different things you can look at, and I think that you gave a great framework, and you had a good discussion in that regard with Jimmy.
I'm sitting here slightly concerned because even though the recording with Jimmy wasn't even 2 weeks ago, I have very limited memory of what you just went through there. I remember there was a great exchange and we had a very enjoyable conversation. Another thing that I completely forgot, and I'm kicking myself, is that in the pre-call we had with Jimmy, he said that when they onboard new people at Clavis, they always have them read a book called The Goal by Eliyahu Goldratt. And I read that book after the pre-call, and I was so excited to discuss it with him in the episode, but I forgot to do so. So I'm going to plug it here now. And the book is a fable, like a fictional business story. And it's about understanding operational turnarounds. And so it follows this Alex Rogo, a plant manager who's given 90 days to save a bleeding manufacturing company from liquidation. And instead of chasing traditional cost accounting metrics, he implements the theory of constraints. He realizes that maximizing efficiency at every single machine is an illusion. So instead, he finds the one bottleneck on the assembly and maximizes efficiency around that, because he knows that's the part that is choking the entire line. And so by maximizing throughput at that single constraint, he slashes inventory, he frees up working capital, and he flips a write-off into a high-margin cash machine. And I found this book just riveting, to be honest. And for anyone in private equity, I highly recommend it as a blueprint for operational value creation.
One of my takeaways from the conversation with Jimmy was how he highlighted the importance of performance on every single deal. And it's a big difference between the independent sponsor model, deal by deal, and traditional private equity. And we so often talk about the benefits of the independent sponsor, the deal by deal model. But I would say this is a weakness, might be strong, but it's one of the less appealing aspects to it. And the traditional blind pool model, because it's a portfolio, one bad deal can hopefully be covered by stronger performers in the portfolio. But in deal by deal land, you're judged on every single deal you do. And so Jimmy talks about this and how that means extreme discipline on the deals that they get into, because they, from his perspective, from Clavis's perspective, they really can't have a single deal. They've got nothing to cover up bad performance. And so every single one needs to perform and perform well. So there is some additional pressure as an independent sponsor when you think about it from that perspective that maybe brothers and sisters in traditional private equity don't feel in the same way. Well, before we get to the interview with Jimmy Watson, a reminder that at Minds Capital, we invest equity into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment, and we average about a commitment per month. So if you're a sponsor raising equity for a platform acquisition, submit your deal to us via our website, mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, there's also a pre-registration form on our website for investors. So if you are or can become accredited, fill that form out to be kept in the loop on our future raises. Again, the URL, mindscapital.co. Here is the Minds Capital podcast interview with Jimmy Watson of Clavis Capital Partners. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James.
Newly acquired and PE-owned companies are high-value targets. Hackers time their attacks when teams are distracted by the deal, exactly when a breach can stall operations, bleed cash, and blow the thesis. Enzo Technologies is your full-service IT MSP for post-close stability. They assess your target, surface the biggest risks in plain English, and give you a day 1 through 30 plan to cut exposure, prevent downtime, and even find cost takeouts like bloated telecom bills. Check out enzotechnologies.com, INZO, or email CEO Nick Akers directly at nick@enzotechnologies.com. Having acquired Enzo himself, Nick understands the challenges sponsors and searchers face when transitioning a business. So make sure to tell him you're an independent sponsor and listener of the Minds Capital podcast. nick@enzotechnologies.com.
Jimmy Watson graduated from college during the GFC back in 2009. After a stint living at home with his parents, he landed a job at Raytheon, where he learned Six Sigma and FP&A. He transitioned to consulting and middle market banking before joining Clavis Capital Partners as an associate in 2018. 8 years later, he is now a managing director at Clavis, this Dallas-based independent sponsor firm that has completed 7 platforms and a dozen add-ons. Their focus at Clavis is on building a repeatable business model. Jimmy Watson, welcome to the Minds Capital podcast.
Thank you, Will. Nicholas, good to be here, gentlemen.
On this point about a repeatable business model, can you elaborate on that, please, Jimmy?
Yeah, it's kind of a big story. kind of the whole culture of Clavis is, how do you create this investment company that enables us to continue to do new deals and make new investments, not just I want to go buy a business off of a potential broker website and run that one business or maybe run two businesses, but create a lot of rigor and process where it becomes, like you said, a repeatable investment company that has tenure and can last for years.
And how do you think that differentiates from other independent sponsor firms?
Well, I think one piece is that we've just been around for longer than many. You've had some guests on your podcast before, great friends of ours that have done the same type of thing. And I think one thing that really parallels all of us is we've worked on building a team, maintaining a strong focus in the criteria and deals that we're going after, and investing our own time in creating tools, templates, repeatable processes, playbooks. It's a lot of buzzwords, obviously, but it's a lot of stuff that we can use to look at new things, new opportunities with businesses, try and find parallels between different companies, different teams, things like that.
So it sounds like it's on the one hand, not buying a business or two, as you said, and being solely focused on that as owners of a small single or two company portfolio, but also it's being able to have the deal flow essentially, so that you have a cadence of acquisitions that you're making, and then of course exits as well. Because we just had a conversation about this the other day, that when you're up to your eyeballs in a deal, it's really easy to let the deal origination side of the business slip.
It's the really key piece, and that's actually one that I think a lot of people forget about, is you get so excited that you've got your tiger by its tail and you get that deal done and you go through the integration. Everyone's pretty tired from months of diligence and transaction work, and then you realize you got to pick up the phone and send some emails and get back in touch with a lot of the bankers and brokers and intermediaries that you've been talking to in the past. And, it happened a lot to us in my first couple of years at Clavis, when I joined Todd and Patrick, who had paved the way for a lot of what we are today. We had a lot of really good process in the transaction work, the fundraising work, post-close work, and strategy development work. But one of the big things that I helped do, and then after me, the other employees and colleagues that we've hired, is to maintain that communication and that pipeline, continue to respond to teasers just so people know you're active. If you stop signing NDAs, people stop sending you stuff. So at least signing some NDAs, looking at some businesses, giving it serious evaluation, right? You don't want to just ignore a good opportunity because you're busy. This is a very busy job for all of us, right? You guys see a bunch of things, right? You don't want to just get so focused yourselves on a couple of your current investments that you might miss a few others on the side, right? So this whole ecosystem needs to be very focused on keeping the pipeline full. And it's been a huge focus of ours, through the duration of my time here at Clavis, but even more specifically, through in the tail end of COVID, everybody was so busy, you needed to make sure you saw the right deal for you. There's a lot of good deals out there, and this is a topic we can talk about too, but they're getting great interest and really high pricing. But for us, you need to find something that is first cut of the rough type of deal, right? There's something a little bit off, or requires a little bit extra work. It's probably the right phrasing of it, that a lot of other people don't want to lean into, but that's great for us, all having the hands-on experience from our, prior employments.
What are some examples of complex stuff that you would take on versus others?
Yeah, Nicholas, great question. I think some of it is you have a team that might have some gaps, especially in the finance suite. We all kind of come from modeling and FP&A background, as Will pointed out early on. So helping build out the finance team and the reporting and the KPIs. It sounds like something that's easy But I think having worked in operations and financial operations before, I worked in a chemical manufacturer as a PE-owned business. I started my career at a defense contractor, working alongside supply chain and engineering. Just having that experience of knowing what kind of KPIs will drive the business is important. Other things that we are okay with are less favorable end markets. We've done very well in finding businesses, really good businesses with really great teams, but they're in a market that's out of vogue at that time. And, thinking, how do you reposition their services into a new end market? One example is, actually, I'm wearing the vest unknowingly for this call today, but UCC Environmentals. It was a 100-year-old business, amazing team, probably one of the best teams I've ever seen and gotten to know. And they were a legacy business serving coal-fired power plants. In 2022, that was not exactly a hot space to be in, not like it is today. But they had such a great skill set, such a great competency, and kind of encouraging them and allowing the investment in people to go pursue other end markets, other heavy industry, semiconductor, other wastewater type of end markets where their competencies were valid and strong, made a huge change in just where that business can go and all the forward opportunities that they have. So it's a lot of work.
Well, we're gonna deep dive into that story, but before we do, Jimmy, just on the point about you were starting to touch on it, but let's hear directly. You had shared with us offline some of the competition that you're seeing in the market now, and losing out at auction pretty badly, not only because you're maintaining discipline, whereas maybe others aren't. So give us kind of a finger of the pulse of some of the deals that you've seen transact that you competed on, but let go.
Yeah, that's a great topic. It's one that we discuss amongst ourselves and amongst our peers a lot. I think there's a very active investment market right now, especially in where we play in the lower middle market, 5 to 30 of EBITDA, and there's even competition that's getting into the 3 million of EBITDA businesses. Nothing new that you've heard, but I'll expand on some of these once I sort of list them off. That larger funds are coming down market, strategics are coming down market. I think for a period of time, and I think it's continuing a little bit now, there are less, call it A+ assets out there. There's a lot of things that have a little bit of this hair, and I think some of the ones that have been more notable lately that we've seen are customer concentration, unfavorable margin compression, really disrupted by some of the macro things. And I think people are, moving toward the safer bets. And still, those are still things that we obviously are looking at, and it's pricing on some of them it's gotten significantly higher than it was a few years ago. And any distribution business, anything that says data center, anything that's power grid related. I think, what was it the other day? I think we got beat by, I'm kind of embarrassed to put this in a podcast, but I think we got beat by somewhere between 10 and 12 times EBITDA. I wouldn't say we were coming in at super low. I thought we were going to be in the kind of at least in the same league, maybe not in the same, the same game as people, but at least in the same league. And it's just incredible on where people are finding value. I think some of that does happen when you have some really good expertise in a space or some experience in a space. And, maybe it's fewer groups are leaning in a lot harder. But I do think that the rising tide of everybody, capital, more investors out there, and you guys see this through your own network growing, it's just things are more expensive, a lot more double-digit multiples than 2018, 2019, 2020, 1 and 2.
We had talked about maintaining discipline in an environment like this, something that you'll hear a lot, but it becomes awful tempting to want to compete and want to win deals. And if you're not able to close on a transaction because you're not at the multiples that the market is demanding, you start to feel like you're sitting on your hands the whole time. So how do you guys handle that?
Yeah, that's honestly something we talk about weekly over here. We're all in this business to do transactions and close deals, and we're all we want to win. So it's very hard to get a lot of, hey, you're not quite there phone calls and emails. The benefit I think we have is we have 3 people that all have to have a unanimous decision to go close an investment. And so, we talk about an investment in the pipeline a lot, and it's good to have, maybe it's that third person that just says, hey, let's pump the brakes. You two are getting excited, or, you're getting excited. I'm getting excited about an opportunity. You're anxious to do a new investment, make a new investment. I think it's good having a team. Having an advisory board, sounding board is a good alternative for it. But just, 1 or 2 people that are chasing, that are just so focused on it, you can make a bad decision. And what we talked about right before this podcast started was, you won't know that's a bad decision for a long time, right? And I think one of the great kind of principles in investing is just try not to lose money. So if I'm happy to miss on a few winners, but I really don't want to have, a real struggling investment that just takes a bunch of time. We do that. That's one of the big things that I think is a Clavis culture move, right? We want to make sure that we're working with all of our teams. And so, trying to think through where's the best way or the best investment that limits our downside is something we continue to talk about.
Independent sponsors need a legal team that understands the model and knows the players. Platt Richmond, a Dallas-based boutique law firm, has deep experience in guiding independent sponsors through the complexities of their acquisitions. The team at Platt Richmond provides support on all aspects of your transaction, from structuring and diligence to financing and securities compliance. They also represent stakeholders throughout the ecosystem: capital providers, lenders, family offices, sellers, management teams, which gives them a unique 360-degree perspective on the sponsor model that ensures a seamless process for your transaction. Partner with Platt Richmond to focus on what you do best: finding and executing great deals. Visit plattrichmond.com today to learn more. That's Platt with 2 T's, Platt, Richmond.com.
One major problem for independent sponsors in overpaying is, of course, that they won't be able to close the deal in the first place. It's simply too expensive and to attract the right amount of equity that you will need to close the deal. What are some signs? I don't know if you've actually experienced that dynamic, but if you were to guess or speculate, what are some signs early on after the LOI that, as you're socializing this deal, this is going to be too big of a slog to raise the equity. I'm not going to be able to get there. Like, how does that materialize, do you think?
That's a really good question. I think something we've heard a lot have been, what is your angle on this? Where do you think that you're going to have this, the operator synergy in a way? What value can we bring? If you're a generalist, I think getting pressure on a higher multiple is going to be greater than if you're someone who's a sector specific or end market specific person, where maybe you really can, buy down the multiple through some growth. One of the big challenges that I think is often forgotten when we're raising capital is, unless you're going to kind of a single person family office, and even many times in those cases, they're getting promoted by the independent sponsor, but then they're going to promote their LPs. So you really have to think about what is their LP's desirable IRR and what their fund or, internal IRR is going to be. And you kind of have to back into that a little bit, right? If you want to go to a deal that's got a low IRR target because you put a bunch of equity into it, you just got to think about what that downside might look like. I think the double promote is a big challenge for a lot of groups, ourselves included. We've had a very hard time with other funded groups for that reason.
Oh, you mean when you reach out to LPs, the institutional investors, not the family offices or high net worth individuals, but the private equity firms that occasionally and more often invest in independent sponsor deals. For them,
That's
the
right.
hurdle is higher and they need to see an even more discounted valuation in order to offset that dynamic.
Yeah, that's probably the most coherent way of saying it. We will look for, I'm sort of ballparking here. We'll do a target of 3 times MOIC for any of our new platforms. Well, we've had a couple conversations where the potential LP to us is looking at 3.5 to 4 times because they're targeting a 3 times MOIC, right?
Yeah.
And then the industrials world, 4 times MOIC underwrites aren't necessarily the most common thing to find.
Well, what kind of valuation do you need in order to be able to underwrite that? If you get a 3x valuation, you can get there pretty easily, right? But
exactly.
7x, not so much. Where is the breaking point, will you say?
I think it's somewhere between this. Well, and here's the it depends, of course. So let's asterisk that and put that in the notes. But I think somewhere in the 7 to 8 times is where you really need to know and be confident in the growth story.
Yeah.
It's got to be actionable. It's got to be straightforward growth, right? It's not, I need to hire a team. I need to bring on a new product and get into a new market. That Ansoff matrix doesn't really work. I think there's, in the 6 times world, you can still at least pay down debt, double your equity. And then all you need is a little bit of EBITDA growth and maybe the professionalization that I think independent sponsors are great at bringing to new investments. Maybe you get a half turn or a turn higher on the exit. So those 3 factors, paying down debt, a little bit of incremental EBITDA growth, and a small enterprise value turn, I think that can get you to 3 times in a lot of scenarios. But too much equity, maybe not so much.
I agree. And I think independent sponsors are somewhat precluded from certain asset types because of this valuation ceiling. You talk about 7 to 8x. That resonates with me. And so that precludes independent sponsors from, for instance, doing SaaS deals, or at least SaaS deals as of 2 or 3 years ago. I think very high growth healthcare deals, just high growth deals in general, are often priced higher than that. And for someone who races deal by deal, that just becomes challenging, especially if they're, less than a decade into doing this. I imagine this changes if you've been at it for 15 years with the same strategy, but it's just hard to raise that many terms of equity and having a narrative and credible story that, yes, we can return not only, the 3x of debt we put on this, but also 5-6 turns of equity times 3, because that's the return we need to underwrite. So, good observations. They're in line with my own.
I think EBITDA quantum is a factor in that too, right? If you're in the 1 to 5 million of EBITDA, you can believe in, taking 1 to 3 of EBITDA. All right, that's good growth. I can believe that. I can buy something for a 7, then all of a sudden it's effectively a 3 if I can get through next year's growth, right? With an earnout, you can add a little bit of structure to get you there. But if it's a 10, 15 of EBITDA, telling you I'm going to go get it to 40, that's a much tougher sell, especially for institutional LPs that would be betting 20 or $30 million on that deal instead of 4 to 5 or 3 to 4 on a smaller EBITDA deal.
And so you bring up just the denominator, so to speak, is important, and it's easier to get big percentage swings, of course, on smaller numbers, which makes sense too. Earlier, you said that one bad deal would crush you. Can you elaborate a little bit on why, if you have a portfolio, why? And we always talk about how independent sponsors, their deals and your carry is not cross collateralized. So if you have a good deal, it will not be diluted by a bad deal that you may have. So why would it be such a catastrophe to have a bad deal for an independent sponsor?
Yeah, there's a unique dynamic here between an independent sponsor and a fund, where while it's not cross collateralized and it doesn't take away from some of the other investments we have, we're always raising deal by deal. And if you have a company that's struggling and as a sponsor of that deal, you're not leaning in, you're not helping work with the team, you're not trying to help recover, whoever our LPs are, and even on the lender investment side, whoever our capital partners are and all, if they see that something goes wrong and we take a step back, that's generally a signal we're not going to do something. They're not going to do a deal with us next time. And this is a very small community, as you guys know. People talk, people move around from shop to shop. The last thing that we want to do, and I think it would be hard to say we'd still be here 13 years later if we behave this way, it would be to kind of put our pencils down and step away from that investment or, turn over the keys. We've gone, through COVID, we've had a bunch of time where we lean in a lot with our teams. We've I'll say we've turned off management fees to preserve cash, and we're working, without getting any current income. But that's fine. We know it's a long-term game. Clavis has been around 13 years. It's going to be around 13 years again, maybe more. And the only way to do that, though, is to really show our partners in a hard time that we're still going to support the team, still support the capital.
What did you mean when you said you turned off management fees?
Yeah. So, back when we were going through kind of COVID and tough times, and didn't really know when sales were going to turn back on, we had a couple businesses that were all impacted, right? So anyway, one of our businesses, we turned off management fees, just accrued it for a few quarters, let the cash stay in the company. And when things were healthy again, sure, we can recoup those fees and have.
Did you opt into this, or was it the covenants that required it?
No, that was before anybody brought it up. We elected to do that ourselves.
Well, I think what you bring up more broadly there is important. For a first-time sponsor in particular, one of the big reliefs of getting a deal done is that you get, mortgage money. You get a management fee. You get a monthly income stream. But that income stream, in fact, is contingent on performance. And granted, it doesn't have to be stellar performance, but if things go poorly, and this is especially possible if you overpay, then you might be underwater and the covenants might block your management fee. And so bang, you're back where you started when you're searching. You have no current income stream. Now you have a bad deal on your hands that you have to repair. And you can't exactly go out fundraising for your next deal once your hands are full with a deal that is underperforming. So this is quite a treacherous position to be in.
Yeah, it goes back to one of our early points about maintaining discipline in your valuation and how you structure the deal. Trying to, proactively assume or build your covenants and your lender cases around what does a downside look like, and will we still be able to move through. You go back and look at whatever downturn or historical dip they've had and sort of replicate that. Maybe add some magnitude, but say, will the company stay within covenants during a tough time? And ideally, you still want to be paid to work on a business, even if it's tough. But sometimes you just got to do it anyway. Yeah. Have you? Question for you guys in your portfolio: how have your partners worked through in the tough times? Have you guys seen anybody do the same thing?
I think there is a bias towards reporting good news from sponsors. Anyone, when they're reporting to their boss or their capital provider, you want to report the good news quickly, and the bad news you want to wait and see, or see how it unfolds before you bring it all to the broader investor group. Before the deal closes, everyone will disagree with that. But once you're on the other side, you start to see that dynamic play out. It's natural, it's human behavior. But I would always encourage people to share news on a regular cadence, whatever it is, because if it's regular as opposed to event driven, then it forces you to share whatever the news of that day is. So let's say you send a quarterly or monthly email to all your shareholders, just keep that cadence throughout the life cycle of your deal, and that way you include both the good, bad, and ugly as you go. Management fees, I haven't seen a ton of people who opt out of them voluntarily like you discussed here, but I have seen, and in fact I've experienced myself, that they get turned off if you are in covenant territory. And frankly, as a sponsor, you want that, right? It's hard to sit with a straight face with the management team when they're busting their ass to get over the covenants levels, or you're just underperforming in general, and take out a lot of cash when you instead can accrue it on the balance sheet. So that resonates, and it makes sense from a business perspective. It makes sense from an investor perspective. It makes sense for the lender. But for independent sponsors who rely on management fees to sustain their lifestyle and pay their mortgages, it's just at least a risk to be aware of, because it's different from search funds where they get a W-2 salary and they're in the operations day to day, and that salary will be paid. good or bad, until the company dissolves, right? It's not about covenants. It's until it dissolves, because it's a salary. So beware of that dynamic for sure. I'll just leave it at that.
Yeah, no, appreciate you answering that. I mean, you guys have a whole mess of good experience with a portfolio of partners, which I think is great too. And I think that's something that is relevant to the topic.
Jimmy, let's turn back now to UCC and hear about that investment.
Yeah, it's a really interesting story and a great outcome, I think, for everybody. So, business that came to us, I think, at the tail end of 2021, and really into Q1 of 2022. Like I said, this 100-plus-year-old third generation run engineered products business, engineered services businesses, where they focus on environmental solutions for primarily coal-fired power plants, generally heavy industry. And environmental solutions is the air pollution capture, solids remediation from the coal ash that comes down the bottom of the boiler, and then hauling the ash out and disposing of it appropriately per EPA regulation, which is an interesting moat. But one of the interesting pieces about that business is they also sell into the power plants performance parts to help with the efficiency and the ongoing operation of coal-fired power plants, crushing coal, conveyance material, and stuff like that. And in early 2022, that was not a favorable place to be in, unfortunately. And we, luckily, my colleague found the deal and did a great underwrite of it. And together with Todd, we did a pretty good fundraise and found a great partner who was more on I'd say, they saw the value in the end market. They saw the value in the tail of coal-fired power plants. And like us, they saw the value of the team and how outstanding the team was, how good they were working together, their pulse in the market, and just their experience in the industry. So that's like one of the key things about it that I think is one of the most fascinating things in our underwrite is if you have a great team that knows the market, that works really well together, that has been around for a while, they generally have untapped potential and can do a lot more, right? Maybe they need new guidance. Maybe they just need a fresh set of eyes. Or in this case, they had a really great family member, but needed a little bit, take some chips off the table and bring in a new partner that could kind of open the proverbial carburetor a little bit, help them jumpstart the business and take a few extra risks. And it was actually not a super capital intensive risk we took. We went out and searched via human capital. We found great people, great salespeople in other end markets that could tell our story and bring that to heavy industry and their relationships. And it takes time, but we were in for it. Our partner is super patient in that. In fact, they're still invested in the business and are kind of continuing on with a lot of the growth that we have all started together. And I think the easy metric to share is they were predominantly coal-fired power plant based from a revenue perspective on the solid side. And by solids, I mean ash movement and ash crushing and all that kind of stuff. By the time we exited the business, they were predominantly wastewater focused as a business, which was an interesting pivot and something that's gaining a lot of traction, is continuing to gain a lot of traction in the market today. And it's an incredible business. It'll be around for another 100 years. What the teams and the investors are doing there is an outstanding, and sad to have exited the business and not be a part of the team, but it was a great investment for us and our co-investors.
And did you intend going into the business to transform it so dramatically?
We did intend to transform it, but not in the end market focus that we thought. There's this, and it's deep and semi-technical, but there are these ponds that sort of live outside of coal-fired power plants called ash ponds. And it's a market that is very attractive from an EPA perspective in that it needs to be cleaned up and people want to go clean it. It's expensive to clean, and there's generally a regulation around cleaning it. I think some of the EPA regulations have been rolled back a little bit, but that was kind of a great target market. huge TAM that we thought would be a great piece to step into. And people had been doing it, but there was a lot of white space there. And we thought, look, let's stick to what we're great at, staying on the power plant property. Let's just clean the coal ash that we helped put out there. And instead, going after that, the capabilities and the services that we were offering and putting in place to go move that water and treat that water turned out to be applicable in other heavy industry. And that's, it's kind of where we focused. It became a natural extension to get into other end markets.
Jimmy, can you share about how EBITDA evolved from you entered to you exited, and also how the revenue mix specifically changed? You said it was nearly 100% oriented towards coal at the beginning, and how did that look at the end?
Yeah. So in the 3-year hold period or 3.5-year hold period, we did help grow EBITDA by about 30%. And part of the excitement was the valuation shift in what those end markets were. Wastewater has a significantly higher valuation than moving coal ash around. And from a revenue perspective, it was predominantly coal ash related, whether it's material handling or performance aftermarket parts. By the time we exited, bookings were well into of project work, probably 70%. I would say it's probably fully about 60% bookings were wastewater related, and with revenues to follow shortly thereafter.
And this was a pretty sizable company. So when you say EBITDA grew by 30%, that's meaningful in terms of absolute dollars. And then you're also alluding to the fact that the valuation multiple increased by virtue of improving the revenue mix.
That's a fair comment. Yep, that's right.
How did you underwrite the political headwinds of this deal? Because you entered during the Biden administration when coal was very out of favor.
Yeah, I think it was a lot in our belief in kind of the melting iceberg, if you will, which is probably a really bad metaphor to use, but just the stability of the revenues. There's just so many power plants that were out there that needed work to be done. And, just in the parts business alone, which is a really good, healthy business, they had a really long tail, right? And we firmly believe that all the retirement announcements were going to get delayed. So they did for various reasons, whether we were right in our assumption or it was an entirely new one. But and then on top of it, all the power plants needed new work done for whatever was in trend for EPA regulation, right? So you kind of had both pieces that were going to the advantage of the company, and sort of depending on if you're keeping the power plants around, you need more performance parts. If you're going to retire the power plants, or if the EPA or if some, cleanup initiatives, EPA regulations increase, you've got large new systems to put into place that are costly and capital intensive that the power plants need to put in.
But I have to imagine this was a hurdle with LPs at the time, because in 2022, I would imagine that, hey, we're all in on renewables, hell no to coal.
Yeah, it was just coal. Saying coal was just not a hot topic for a lot of people, and it was very binary for many groups, including lenders.
Yeah.
But luckily, we found a great group in our lender group and a great group with our equity LPs.
You mentioned one of the successful tactics that you deployed was to hire salespeople that had focused on other end markets in their previous careers. Is this something you could do everywhere? A good salesperson is a good salesperson, or was there something special about this situation?
No, I think it's pretty transferable. It's something we've done with our portfolio, other portfolio companies. We have a business that's working on an e-commerce channel, and we hired an expert who came from a much bigger institutionalized business that does that and has brought that skill set to the company. We're working on that now with another portfolio company on moving just geographic network, right? You're selling into people and there's some geographies we don't sell a lot into, and by bringing some local knowledge that knows our products and what we're trying to do and who we're trying to sell to, it's very transferable across, I think, many of our investments. Sector experts, product experts, regional experts. I think it's a disservice to not bring some of those people into some of the companies. I mean, it's one of the growth initiatives that everybody puts into the book is expansion, defining how you expand and telling me I know a few people that would be really good people to do this. That's what makes us buy into a lot of growth initiatives when we see new sims.
On the front end, most private equity deals, and especially independent sponsor deals, I would say, you can ideally get the outcome you're wishing for by some version of continuing as is. The word transformation rarely comes up in an investment memo from an independent sponsor to an LP. And so here you're saying you had political headwinds and you relied on a transformation. How does this become palatable for anyone?
I think transformation is a strong word. It's more of a natural extension of where we were. From an engineering company who's got a lot of really talented individuals, and you create a lot of systems, and these power plants and the teams out there, hiring people that maybe know wastewater versus people that just know are mechanical or that are electrical, on the engineering side. It's solvable through hiring, and it's not super transformational. When I think transformation, I think you're pivoting your whole business model. We luckily are not pivoting our business model. And I fully agree with you, Nicholas, that if someone says transformation in their book, that is a lot of work, and the risk of executing that is dramatic.
Right.
And it's one of the big things that we look for, and we sit down in our own IC meeting is, I need 3 super actionable, very straightforward, and read as not complicated growth initiatives that we can actually do. I am not an automotive expert. I am not a electrical contractor expert, right? I can't go into these certain businesses and say, I can lend this value and I know how to do that. But what we can do is say, we have a playbook and we have a process, and we can help you guys take all of this knowledge that you have. You're the operators, you're the guys in the field, the customers and the suppliers. Let's sit in a room, let's put that together, and let's think about what can we do with easy investment. And people are good, easy investment, right? If the people don't work out, you can hire a different person or go back out to the market. If a product doesn't work out, you probably paid for inventory. But if you've pivoted your entire marketing and everything and your whole mission and what you're doing, it's really hard to go back to it. And then you kind of get stuck in a lull, and that's a lot of time suck. And I think the investment in time is the biggest piece of it all.
So Jimmy, the pivot to wastewater, not the transformation, but that pivot, was that just one of the 3 growth levers that you guys had at IC before you bought the business?
Yeah. I think it was pretty straightforward in that continue to grow the parts business, which was something they're great at. And it was what additional parts can we sell to the power plants? There are a lot of wear parts. And so there's a lot more that those go on. Those parts can also go into other end markets. What other wear components go into heavy industry? So the parts business had a couple of its own, and then growing the projects business was moving into this coal ash pond dewatering market, and that was the biggest piece of it. So what technical expertise do we need? How do we get in there? What engineering expertise, so technical on the sales side and technical on the engineering side, do we need? Luckily, we did it, I think, really effectively with a piloted program on site that did very well. And so it was kind of baby steps. It took time, but I think all pivots do. I wouldn't even say it was a pivot, right? The business still continues to do what it did before. It's just an extension of their service offering.
But this was working really well, the pivot or whatever we want to call it, the extension of the service offering. And so why was the whole period shorter than usual at 3.5 years, I think you said?
Yeah. We accomplished the goals we set out to do. And as any investor, the job is to return money to your co-investors. And it became a great time for us to close our chapter and let the company take its next chapter.
What was the outcome?
Yeah, it was a good positive outcome. It was kind of an opportunity for us to exit the business, and instead of looking to do a transaction or take another chapter with the company. We had our bird in the hand, if you will, and it became a great outcome for our co-investors. And it was something that, as an independent sponsor, you don't really get a win until it's on the board. And so it was a great win for us to put on the board, and great return for our investors, and a really good experience for our team.
The bird in the hand strategy choice, is that effectively how the decision always is when you exit a private equity deal that has been going pretty well?
I think that there's a lot of, well, what if I get more? Or what if we do something else and sit in it a little longer? And I think in today's environment, I think it is very wise, and maybe I'm not the wise person to say it, but to take an offer when you can and put points on the board when you can. Wanting to try and do something 6 more months or 1 more year when you've got a really good opportunity to exit, it's a win for everybody. I think that's again, that's kind of what we're here to do, right? We're here to return money and provide a good outcome for all of our co-investors. And if somebody solicits a great offer, or you run a process and it's good and it's good enough, I think that it would be silly not to take it.
What would be some scenarios, or what would be some profiles of people who would opt for the 2 birds in the bush instead?
That was a great question. What do you think? Where have you seen it in some of your investments that maybe you didn't get the exit and somebody wanted to hang around a little longer? What were they looking to do?
I think it's extremely case by case. It's hard to put a general through line on that, which is probably why you threw the question back at me. But I think you can go back to what you initially were pitching. And so if you still have room to grow or room to go in terms of that value creation plan, and you feel like you're not there yet, that would be a consideration. The offer, a good offer at 7x is also different from an unbelievable offer at 14x from a strategic. So those would be 2 separate situations. I think a big part of it is the saturation of the people around the table, not only the management team, but you as a sponsor and the board members and the shareholders more broadly. If you're 18 months in, people are still motivated, right? So it's going to be different from when you're approaching the 5-year mark. So that factors in as well. But in general, I tend to agree with you. This game is about doing multiple good hits and getting base runs as opposed to getting 1 home run. And if you can deliver 3-4x MOIC, that's a win any day of the week. And there are going to be fewer regrets with that. I think also there's the matter of working capital, right? If you have a win like that, you get carry, your investors get cash, and so that can help fuel your next deal or fuel your ongoing operations to continue to scale as an independent sponsor. So I think we can agree here that there is no one answer to when to exit versus not, but it's a realistic and probably a sober approach to always be cognizant that this is a good outcome. It's not necessarily what I dreamed about 6 months ago when XYZ happened, but overall, let's take it.
Yeah. You never know when COVID or tariffs are going to happen, and you're sitting on an investment that you could have exited in 3 years, and now you're 6-7 years into it.
Yeah, we had someone on here at some point who was categorically against, because you have the whole movement of people who are like, holdco, we're great businesses, let's hold them forever, regardless of what happens. And I think he was pretty succinct in shutting that down as a kind of a blanket statement. These are case-by-case situations. Every industry, every target company, every people congregation is dynamic over time.
Yep. I couldn't agree more with that. Just like every investor is their own investor.
Jimmy, changing gears here a little bit, we got you for just a couple more minutes. But you were recently on another podcast and saw that one of the most popular segments of that interview was about you talking about how you got into being into the independent sponsor private equity game and what others, how they might follow suit or what you would recommend to people coming up behind you. What did you say?
Yeah, that's a good point. It's being an independent sponsor is a little different than I would think being in a fund. Not that I have been there, but you wear a lot of hats here. You're not necessarily segment approached and stuff. We do everything from helping with the portfolio company and FP&A to strategy to fundraising to transaction work and everything like that. And earlier in my career, I spent a couple stints in different FP&A roles, and I think that was something that gave me a lot of more well-roundedness, as well as being a consultant at Ernst & Young and Riveron back in its earlier days. And part of the way I got in here was just through networking. The Dallas independent sponsor community and the Dallas finance community are really tight knit and really good people, and looking to help each other out. And former coworker Patrick reached out to me 9 years or so ago and said, "Hey, we're trying to hire. We've gotten to know him for a couple of years." He said, "Would you be interested in joining?" And it took us about kind of a year to get everything together. But I remember right before I joined, I heard Todd speak on a panel, and he was talking about what it is to be an independent sponsor and how you do more and you wear all these hats and you get this great experience, soup to nuts, on an investment, and how hands-on he and his culture that at the time and who we are still today are in a portfolio company. And it resonated really well with me. And I found it to be a great opportunity to get into the private investment world and how I could continue to bring my skill set, not just come in from a banking background and leverage those great experiences that a lot of individuals have, but I got to come in with a different skill set that immediately jumped into going to go help our businesses, build out 13-week cash flows, build out budgets and forecasting tools and things like that. I think those are just some great experiences that I had. And it's a really challenging thing, I think, for a lot of people earlier in their careers, is they don't know what an independent sponsor is until you're already in the market. And I wouldn't necessarily say it's a great job or an idea for someone who's 25 to necessarily go try and be an independent sponsor, but maybe they'll do great. I think it's a great position for people who have a lot of experience and who do their homework and come in eyes wide open. But it lets them be their own owner, right? A business owner, an investor, work directly with the team, which I think is one of the coolest things about what we do, and work with a lot of really interesting people like you guys and other co-investors that, you get to meet all these new people, right? If it's a fund, there's some institutional LPs and maybe you don't get to talk to them, but one of the things I love is I get to talk to our co-investors regularly, and they're good people. They have great insights. They provide value. You can ask them questions, and you kind of get a little bit of a community around each one of your investments that I think is pretty fun.
Mm-hmm. That's well put.
Jimmy, one of the most successful entrepreneurs that I know used to work as in FP&A at Victoria's Secret. What actually is FP&A? I understand it is financial planning and budgeting, but can you talk a little bit more detailed about it?
Yeah, that's not the company I expect you to mention. No, FP&A, financial planning and analysis, to break it down and save everybody the AI search. I mean, where it really comes into play is, it's not, in my mind, it's not a purely financial role, but it's more of a business ops role where you're planning out labor, you're planning out production, you're costing it and helping cost it, you're looking at margin, you're looking at cash flow. I think it's a lot of the future forecasting of the health of the business, as well as how dashboards and KPIs and putting a lot of stuff together to help people monitor and be held accountable. What I like about it versus a lot of true core isolated finance roles and accounting is it touches a lot more of the business. It's stuff that gets reported up to senior levels. So at an early age in my career, you got really good senior exposure. It touches ops, it touched engineering, it touches procurement. In many cases, it can touch HR for recruitment and that kind of stuff. So it's a good way to understand a business. I think that was one of the things I really enjoyed most in my time at Raytheon and Demilec was you learn the business pretty intimately by having to do all those analyses and talking with all those people.
Thank you for that, Jimmy. And thank you for coming on and sharing your career so far with Clavis, and particularly on the UCC investment. We really appreciate your time. Jimmy Watson, thank you.
Thanks, Will. Thanks, Nicholas. Appreciate it, guys.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also, check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraisers. See you in the next episode.